Welcome back to Over the Horizon, a Bitcoin podcast. Today I'm here with Chris Drzyzga, partner at Voight Real Estate Services and a real estate and Bitcoin expert. Chris, how you doing today, man?
I'm doing great, Joe. Thanks for having me.
Absolutely. This is our second time trying to run this. The first time the audio was corrupted, so hopefully we're not as unlucky this time. But either way, this being a second conversation, we now have even more things to dive into. First things first, I want to give you, let you just have the floor for a minute, give an intro about yourself and how you got into this space, and then we'll talk about some of the news before diving into kind of your thesis about Bitcoin and real estate.
Yeah, absolutely. Thanks again for having me. Round two here. I got into the commercial real estate brokerage world right out of college, right as we were crawling out of the great financial crisis. And I got into it always wanting to be a real estate investor myself and have my own portfolio, be a landlord. And I figured, working on the brokerage side was the best way to get experience and see a lot of different types of deals and just learn the business. And along that way, I was, doing everything I could to save up for down payments and look at different opportunities for my own portfolio, and just realized, every time I got to a certain milestone, the goalposts had moved. Right, it was the asset values were moving away from me faster than I could save for it. So I knew there was something wrong there. I couldn't really put my finger on it at that point. And, fast forward to 2018-ish, 2019, found Bitcoin the second time and gave it a little bit more time and diligence, before I ultimately fell down the rabbit hole. And that was the start of it, and realized the implications to real estate and just the broader investment landscape the deeper my knowledge grew about Bitcoin. And so I kind of kept baking that viewpoint, this thesis for the last few years, and I didn't really come out public with it because there was always one piece of the puzzle missing, and that was cash flow. So when Strategy released the perpetual preferred instruments beginning of this year, it was really the last piece of the puzzle. Like them, hate them. There's a lot of different opinions on them out there. The fact of the matter is, Bitcoin could have had a 200% CAGR, right? But there's a large segment of the real estate market that depends so much on the monthly cash flow, the cash flow distributions, that you weren't going to get their attention. And then with these new preferred instruments available to any investor, paying 500-600 basis points more, you start to realize that this is a real competitor to the real estate space. So that's where, that's the short story as to, my journey and how I got here and why I started talking about it. I think we're going to get into it a little bit more here today, but there's a lot of changes going on in the space, and a lot of people are, still thinking that it's business as usual.
Absolutely. One of the major changes we've seen recently was JP Morgan coming out late last week and saying that they would now accept Bitcoin as collateral for loans. Talk about why that's a significant development and what kind of a milestone that is on Bitcoin's financialization from becoming this sort of niche speculative asset into one that's really integrated into mainstream finance.
Yeah, wow. That definitely caught me off guard as well. Massive development. The just from the standpoint of what it does for awareness and broader adoption is cannot be um, cannot be overlooked. But just the fact that it's going to be on everybody's radar is going to help tremendously as far as getting everybody up to speed and comfortable with it. But the second piece of it is the majority of real estate owners have debt on the asset. In commercial real estate, where I play, those loans are anywhere from 5 to 10 years in duration before they're getting refinanced or paid off. So to be able to have a product like this, whether it's a hybrid product or you're just using the bearer instrument, whichever that is, as an option to the real estate portfolio is huge. And the one thing that really caught my eye there was that I think if I'm not mistaken, they had mentioned that they were going to be they were offering it by the end of this year, end of 2025. So, I mean, that's 60 days out, if I'm not mistaken.
So these things are happening rapidly. Bitcoin obviously has had a bit of a tumultuous year. We won't get into price action, but this type of low volatility in my mind, is exactly what you need for people to perk their ears up, I believe. I think Bitcoin historically, one of the major points of detraction against it was its insane volatility. The fact that it had rolling volatility that was higher than any major US stock index. And so the ability to pledge it as collateral or take it seriously in a universe of other assets, particularly with something like real estate, was just something that was not feasible at all. But with Bitcoin's volatility being extremely low, granted that comes with awful price action, it's something that on a secular basis is good for Bitcoin adoption. I think it's good for the financialization of Bitcoin. Let's talk about the alarm bell here, right? So back in August, you had a tweet that went very viral. You went through essentially why real estate was at a breaking point. You discussed, this cocktail of forces that were forcing real estate to this position. Those being monetary debasement, obsolete inventory, new competitors for capital. And so after all of that, recognizing those things, seeing Bitcoin, you decided to go public about these views after years in CRE. And you went quite viral with them, right? Because this is just now a topic that's being brought up, the intersection of Bitcoin and real estate. There's been some writing on it for a while, but now it's finally coming to practice. So what pushed you to finally ring the alarm bell per se about real estate?
Uh, I mean, as far as what pushed me, it was again that cash flow piece, right? You have the store of value, the growth angle with spot Bitcoin, and now you have the cash flow piece with these perpetual preferred instruments. So that was really the reason I decided to speak out about it. But you have, as far as ringing the alarm bells, you have the store of value issue, right? With Bitcoin being that superior asset and trying to understand what that does to the real estate asset class over 5, 10, 20 plus year horizon, right? I mean, for today, there's somewhere between 200 and 500 billion dollars of passive flows into the real estate asset class. That's commercial real estate. So again, at what point does, that $500 billion a year become 400 and 300 and 200? And what are the implications to values, leases, loans, uh, everything? And that's just the Bitcoin piece of it. When you look at some of these other macro trends that you're talking about, demographics, technology, automation, generational preferences. I mean, it's all of it. Those issues, and then you look at the real estate inventory, right? In the United States, there's about 87 billion square feet of commercial property. That's office, industrial, retail, and apartments. Those are the four major food groups. There's a handful of specialty sectors, but for today's conversation, let's just use 87 billion square feet of space. 62% of that, 54 billion square feet of it, was built before 1990. So that entire inventory base was built in a different era. It was built when there were different business models, different consumer demands, all of it. So you take that and then you look back at Bitcoin and all these other secular trends that are taking place, and you come to the conclusion very quickly how disjointed this marriage is, or how obsolete the existing inventory is. And the next question you ask yourself is, who the heck owns all this stuff? And when you start to look at that, you're going to find that 60% of it is privately held. That's after you take out the private REITs. That's after you take out the private institutional funds. If you add those guys in, you got another, handful of percentage points, so probably closer to 75% ownership. So that aside, 60% of it, that's owned by you and me, mom, dad, grandma, grandpa, business owners, small funds, family offices. It's mainstream, right? So as these trends continue and continue to mature, my concern is that by the time most people realize what's happening, the train will have already left the station. Because if you're not familiar with commercial real estate, our world moves at a glacial pace compared to stock markets and everything in our digital societies today. I'm not saying sell all your stuff and run to the hills. I'm not saying real estate is going to zero. But what I am saying is that the old playbook does not work, and you have to be really objective and proactive about how you approach and manage your real estate moving forward because of these things.
Yeah, we're going through a structural regime change. There's so much happening in the world. And for me, thinking about commercial real estate, a lot of these trends are kind of dematerializing the need for CRE, namely office space. I don't know if you could speak to office space, but there seems to be at least a headline a month about major delinquencies in office space. I recall 2 years ago, very, very clearly, the delinquency rate on office commercial mortgage-backed securities had crept to an all-time high because of lack of tenants. And this was right around the time that I think GPT 3.0 released. So call it a coincidence, call it what you want, but clearly the work from home paired with the AI boom has dematerialized the need for a lot of commercial real estate, namely office space. So can you talk about that shift a little bit more? Like how is the utility value and the value proposition of commercial real estate changing because of these technological trends we're experiencing in the country?
That's a good question. We're realizing that we're overbuilt in a lot of these property sectors. I mean, office is the easy one to pick on these days, but 7, 10 years ago, it was retail, right? And Amazon was going to obsolete and dematerialize retail properties. Some way, somehow, it managed to survive, and it's in a different form today, different types of tenants, and it's still a viable option in the real estate world. There is a flight to quality taking place across all property types, across all markets in the country. The best performing assets are the highest quality ones, which is actually, I mean, if you try to negotiate a lease or find space in one of those top tier assets, you're going to find that you don't have a lot of leverage as a tenant. The landlords hold all the cards. You're not going to get as good of a deal as you may think you were going to get or were expecting. That's, call it, the top 10, maybe 15% of the market. You find yourself in that bottom, call it 80, 85%. It's anybody's guess what issues that landlord could be dealing with. In the office sector, specifically, office is a really capital intensive asset. The upfront capital cost that landlords incur to get a tenant into the space it's off the charts. I mean, we used to build out office space from a shell to, class A finishes for $65 a square foot. Today it's 125-ish, 140. So it's more than doubled in, less than a decade. So a lot of the time that upfront capital contribution and relative to the rents that those buildings are commanding today, it just doesn't match, right? So those owners, those operators are in a tough spot where they have to make a decision. Do they throw capital at it and hope for the best, or do they just let it go? And we're finally, with your comment or with your question on the loan delinquencies, you're starting to see that materialize. The banks and the lenders were playing that extend and pretend game for quite some time, which I think was good. They learned their lesson in '08 and '09. They don't want the keys back, right? That's not their core business. They don't have the infrastructure or the expertise to operate it at the level that they need to be operated at. So this time they worked with their borrowers and extended and tried to give them as much latitude as possible to stabilize the asset. Some of them accomplished it, others didn't. And now you're seeing that latter group give keys back, which is a healthy part of the cycle. We needed that.
Of course, it's a major correction. At the same time, we're seeing a regime shift. The Fed is bringing rates down now. Like the Fed is kind of at a moment where even though price inflation is really high, there seems to be a secular slowdown in the labor market to some degree, and so they're bringing rates down. Um, Moving into this like loosening credit environment, do you believe that real estate stands to do quite well, or do you think that up against these forces that we're discussing, do you think that this trend is just going to continue? It might do well in the near term, but it's still in a secular downtrend in terms of its utility.
Yeah, I think you nailed it on the head there. It's will likely do well in the short term, right? I mean, I think we got another 25 basis point cut today. How material is that from an underwriting perspective? It's not. It's not going to change the figures all that much, but it does a lot more for market sentiment and market psychology than anything. So you have that. In the short term, is there some kind of, I don't want to call it a melt up scenario, but do you see some of these assets, squeak a little extra equity out of them because of the environment? Probably, but you're going to get to a point, and we saw this in 2021 and 22. You're going to get to a point where there's no marginal buyer for a large part of this stock. Right. I mean, again, this goes back to the 62% of the inventory that was built before 90, right? You can go across every single property type, industrial, apartments, office, and see where that structural obsolescence, that functional obsolescence is. And at some point, like if it's an industrial warehouse built in the 70s or 80s, it's probably got a 16-foot clear, maybe 18-foot clear. It's got 2 to 400 amps of power. It's got shallow bay depths. That that may work for some businesses today, but it's not going to work for most, especially as you look into the back half of this decade and beyond. And you're not going to be able to command a premium in the market from a lease or a sale price standpoint.
So you said before that this isn't just another cycle, and I think you've kind of described why that is exactly. I want to shift gears to talking about commercial real estate and specifically how commercial real estate works. So one of the things that you've been touching on to this point in the discussion is the amount of upfront costs that's associated with putting a new tenant in a building. And so a landlord today more than ever has to grapple with the opportunity cost of finding a tenant and keeping the building or just throwing the keys away, right, and selling the property. So how does a typical commercial real estate investor actually make money? And how is that harder today than ever before?
It's definitely harder today than ever before. That's for certain. I mean, you used to see there were a lot more real estate investors that were buy and hold, right? The value guys that were, they were accumulating properties over a 10, 20, 30-year career, and it was a cash flow play, right? You don't see those guys very often anymore. The returns are made on the exit. So the real estate investors largely today are buying properties, holding them for 3 to 5 years. They're doing some sort of, they call it value add strategy during their hold period, which is really just a fancy way of saying, I'm going to make some cosmetic upgrades, slap a coat of paint on it, maybe rebrand it, right? That's the big thing right now is we're going to rename the property. We're going to
I'm going to
push.
rename this shopping center into an outdoor mall, and then I'm going to exit in 5 years. I've seen so much of that. Is that kind of this idea here?
Exactly. Yeah, the outdoor mall is one of them. If I saw one today where the address was 5001, right? So rather than just doing 5001, they spelt out 5001, and that was their rebrand. And they're pushing rents, they put a fresh coat of paint on it, and they're going to look to exit in 3 to 5 years. They're going to make their return probably, mid to high teens on that exit. That game is over with as far as I'm concerned. I mean, if you're going to keep pace with where the markets are going and what the alternatives are offering, you have to have a comprehensive strategy that you're going to apply to every asset across an entire portfolio.
Very well said. So it's mostly cosmetic then. It's not actually buying
Largely.
this, holding this for the long run, 10, 20 years. They're much shorter periods of time. The acquisition happens. It's some kind of cosmetic, superficial rebrand, then they let go of it. That seems like a huge regime change in commercial real estate. Why do these short hold periods make the system more fragile than it was previously? Because in my mind, if you have these investors who are buying properties, holding them for, 5, 10, 20 years, that's a real investment, right? Where this sounds more like house flipping, what you're telling me. If I'm to analogize it to something that I think more of our audience understands, it sounds like that's not necessarily a system that could survive an extended market downturn. If they're banking on the exit rather than cash flow, I think that makes them really sensitive to the business cycle. And should we see an extended market downturn, a lot of these commercial real estate investors with these short hold periods just can't survive. Am I wrong in saying that, or is that a fair
No,
observation?
that's exactly right. I mean, and that is what you're seeing is each investor comes in, they try to squeeze as much out of it as they can, right? They try to keep their capital expenditures as low as possible. They try to do their lease up as fast as possible at the highest numbers they can, the market will bear. And then they they flip out of it. And the next guy comes in and does the exact same thing. So it really just comes down to not being the guy holding the asset when the music stops. That's what we're talking about here. Along that, the cosmetic improvements that they're doing and any kind of, if they're rebuilding an office or they're doing any kind of renovation or construction, you can see the really poor quality of labor and work that goes into these spaces. The one common denominator that all of these property types that have performed well over the last 6, 7 years is that they've been quality, right? Quality location, quality improvements, quality user or customer experience. And again, that's not the majority of the market. That's the top 10%. So I think I answered your question there.
That's perfect. That's absolutely perfect. That doesn't seem like a really sustainable model. Is that model on its way out? Is it dying? Like, are more people realizing that that's not something sustainable and deciding to exit commercial real estate entirely? Like, you have a pulse on this industry. Obviously, you've explained where it is today, but where is it headed currently? Where do you see the current trend line moving as far as CRE goes?
There's a lot more awareness and in the commercial real estate space about where the puck is heading than you would probably guess. When I started speaking out about about this topic in particular, the feedback was incredibly from the industry was very positive. It was a lot more receptive than I expected, and a lot of people were curious. And I've been chatting with people across the country. They have different types. They're in all different areas of the space. And there is a cohort of investors that are, if they're not selling the real estate portfolio outright and reallocating into Bitcoin, the ones that are holding on to the assets are trying to figure out how to integrate Bitcoin into the asset, whether it's from a treasury standpoint, a financing standpoint, an energy standpoint. There's a lot of really smart people in the space that are working really hard about what does this look like? How do we as an industry help facilitate this transition? So that's a good thing. But we still have a long way to go as far as the conversation getting the major players. That's for sure.
Gotcha. So it's a shift occurring at the margin, but certainly a lot of the major players haven't stepped into it yet. I want to pivot this discussion now to real estate and how it plays into commercial real estate, or Bitcoin, excuse me, and how it plays into commercial real estate. So you already touched on it briefly, right? You mentioned Stride, Strike, Strife, and Stretch, right? These are the preferred stock instruments that are offering huge dividends that are backed by the Bitcoin on Strategy's balance sheet. How is Bitcoin now competing with real estate for capital, right? In the mind of a commercial real estate investor, given the choice between buying a property, developing it, and then exiting in 3 to 5 years, and doing something like purchasing one of these preferred stock instruments based on the risk appetite, how does Bitcoin directly compete with real estate for capital?
It's a superior option in every way, shape, or form. That's and what it comes down to is the education piece, right? I have yet to find a real estate person that understands Bitcoin that can make a compelling argument to the contrary. The house flipper example you had mentioned earlier, right? I mean, the house flippers, they're taking tremendous risk over, call it a 90 to 180-day period to get mid to high teens on a return. Maybe they get the low 20s. And that's if everything goes perfectly, right? The commercial guys, they're in a similar boat. If you're out at trying to raise money for a deal or for a fund, your pitch is, you're offering a 5 to 7% annual return, cash flow. Your capital's tied up for multiple years. There may or may not be a capital call along the way. And then when we exit, the high teens, low 20s on our return. That's the pitch. And has been the pitch, and that's been a great pitch until Bitcoin. So as the market realizes that spot Bitcoin has grown at 60% a year, and there's no maintenance, there's no tenants, there's no commissions, there's no jurisdictional risk, except I find it really, really hard to see a scenario where Bitcoin does not naturally absorb a significant portion of that capital that was previously earmarked for real estate. And that's before you start looking at these perpetual preferred offerings, right? If you're a retiree and you have an apartment building or a small industrial center, right? And that's your, you live on that cash flow. You're getting what, 5 to 7% a year. You have all kinds of tenant issues. You have leasing. It is not a passive investment, is my point, right? There is a lot of elbow grease that goes into operating that asset and making sure that it's relevant and competitive. So when you look at that segment of the market, there's going to be a chunk of that capital, a chunk of those investors that say, "Hey, I'm done with the tenants and the toilets. I'm going to put my capital into Strife, STRF, be senior in the capital stack, 5 or 6 times over collateralized, pays quarterly. It's got I think the liquidation value, if I'm not mistaken, is $100 a share. So from a real estate perspective, that's my land value. So again, it's an education, it's a function of education, and as that education occurs, whether it's through podcasts like this or JP Morgan and the army of financial advisors across the country talking to their baby boomer clients, this is going to happen over the next decade.
It certainly seems that way. I don't think the institutionalization of Bitcoin is something to be ignored, right? JP Morgan, the largest globally systemic bank, coming out and saying that they'll accept Bitcoin as collateral for loans. Sooner or later, more people are going to realize that that is a no loss business, right? An over collateralized Bitcoin loan that can be liquidated 24/7, 365. There's no credit risk that's carried by having Bitcoin as collateral whatsoever. And so I think the more that people begin to understand that, the bigger a shift can occur and the more options that are available, right? You mentioned spot Bitcoin and then you mentioned these preferred stock offerings. There's something for everybody, regardless of their risk appetite. You can blend the two. You can add this as part of your capital stack rather than going in and buying one building that you may be on the fence about. You may allocate your proceeds to Strife instead, or a portion of proceeds to Bitcoin and then Strife. The more instruments that are available and the more deeply embedded this becomes in our financial system, I do believe as well that this is a trend that is going to accelerate. And this is kind of, you mentioned like the ROI that somebody can expect on a property, right? Maybe, low to mid teens, or sometimes low 20s on a yearly basis. And then they exit after 3 to 5 years. With Bitcoin, you're looking at a 60% CAGR just this year over the last 5 years. It's, I believe, 60% as well. So this thing is a proven track record. And then if you do want that cash flow, which real estate investors really do, then you have a bunch of preferred stock offerings that can give you that cash flow that are tied to Bitcoin. And so in a very real way, right, the whole cash flow component of Bitcoin, which is why people haven't invested in it, that's now fallen to the wayside now that we have these preferred stock offerings. And so in a very real sense, whatever Bitcoin's compound annual growth rate is, that's your hurdle rate. If you don't clear that, the investment doesn't make any sense. And I do believe the more real estate investors find that out, the more Bitcoin will demonetize real estate.
I think you're exactly right. It's important for real estate investors, real estate developers as well, to realize that their competition is not the building across the street or the submarket that they're playing in. It's those two, but it's also this emerging asset class as well. And the emerging asset class is superior and doesn't have any of the risk or the frictions that traditional real estate does.
Absolutely. I want to talk about the potential of dual collateralizing loans, meaning to say a loan that's collateralized not just by the building itself, but also by Bitcoin. Can you explain this concept of dual collateralization and how it could transform real estate financing?
Yeah, absolutely. So the good thing is, or the nice thing is, dual collateralized loans for real estate investors is not a foreign topic at all. Right? It's actually quite common. In today's world, the second form of collateral is other properties, a UCC filing, a basket of securities, what have you. What we're talking about here is just replacing that second form of collateral with coin instead. So from that standpoint, it should be a very easy topic to approach with a lot of these investors. And I think when you're having that conversation, being able to explain some of the basics, right? The fact that it's not a margin loan, it's a mark to market, or excuse me, it's not a mark to market margin loan. It's a long duration credit product where the real estate and the Bitcoin are underwritten in the same capital stack. So unless there is some kind of a distressed scenario, the Bitcoin is not moving. It's not trading. It's not selling. It is locked up for the duration of that loan until it matures or refinances. right? And that again, that's a 5, 7, 10-year time horizon typically in the commercial world. So when you can start with that foundation, you can take away that volatility objection or that volatility concern very quickly because you can now show them, hey, over a 5 or a 10-year period, the volatility is much less and the appreciation potential is much, much higher. So that's the way to approach it with the real estate investor. And like you were saying with JP Morgan and Wall Street, they're eating it up because they're able to see this duration curve, right? That they can now underwrite and it has some sense of predictability to it, right? Because they can go behind the scenes and say, X amount of Bitcoin is locked up for Y number of years, and they can calculate the free float from there. So again, that gives them that predictability over a longer term horizon that they haven't had in the asset class before. So it touches, it resonates with the borrower and it resonates with the lender as well.
It strengthens your capital stack. It really does. And that's a very important theme I think we'll see playing out over the next several months and years. And it will become a mainstay as far as collateral is concerned.
I like to say that it's a counterbalance, right? Because as that monetary premium gets drained from real estate, whatever rate, whatever time horizon that ends up being, you're going to recapture that value in the Bitcoin. So I try not to say a hedge. I try to stay away from that word, but that's what it is. The premium is draining from real estate and you're recapturing it on the other side with the.
Very well said. It's a demonetization of one asset and a monetization of the other one. Obviously, there's no real way to necessarily measure capital moving from one asset directly into another, but you can see a demonetization trend with Bitcoin relative to everything else, right? Meaning, if you look at the growth rate of Bitcoin's market capitalization relative to the total value of global real estate, I had mentioned this to you the last time we spoke. It has increased 6x relative to global real estate over the last, or 40x relative to real estate. Excuse me. I'll edit this part. 14x relative to global real estate over the last 6 years. That's insane. And so, you talk about monetary premium. I don't know if you have an internal estimation or an internal calculation as far as what percentage of each property is pure monetary premium. It can be calculated by replacement cost. There are numerous ways to calculate it. I did my own report where I calculated it based on replacement cost as well as a few other variables. And I came out with, at the very least, there is a $130 trillion monetary premium in global real estate against a $370 trillion value, right? So a substantial portion of global real estate is pure air. It's not the land that it's on. And this is a huge misconception, right? I think maybe in your work, you can correct me if I'm wrong, but I imagine when people think real estate, they're not thinking that the value inherent in a property is just pure speculative premium. They're thinking it's tied to the bricks, the mortar, the land, the utility value of that property itself. I think that's one of the biggest misconceptions today, the biggest hurdles we need to leap over for people to understand the utility of Bitcoin and how real estate is just completely overvalued relative to its actual practical cost.
Yeah, absolutely. The monetary premium, and by the way, that report you guys put out at Horizon was absolutely fantastic. I recommend anybody that's interested in real estate, whether you own something or not, take a look at that report. Read it was fantastic. And I believe if I recall correctly, you guys had come up with you had valued it or calculated it two different ways, and you basically came up with a 30 to 35% premium on real estate. And I think for most, that's a really good baseline. But I think there are arguments that could be made that it's much higher than that, well into the 40s, even maybe 50%, uh, as far as a monetary premium is concerned. So you have the land and the structure that is part of the value, but in commercial real estate, a large chunk of that value is based off of the tenant and the cash flow stream that comes from said tenant. So in commercial real estate, you can hear the phrase a credit tenant or a core tenant. That's just real estate jargon for it's a high quality balance sheet, a high quality tenant, right? Maybe it's Amazon, something like that. A mom and pop, a small business owner, a local business person is not going to be considered a credit tenant. So that two pieces of real estate, two identical pieces of real estate, one credit tenant, one local business owner, those are going to be valued very differently simply because of the strength of the business, the quality of the balance sheet. I think there's also something to be said about some of the premiums that people pay for those cash flow streams because of the sense of safety it gives them. I mean, I can show you deals where people were buying warehouses that were leased by Amazon over the last 10 years, and they were paying 2 and 3 caps for it, which a 3 cap capitalization rate is just a down and dirty estimation of the cash flow that the thing's spitting off on an annual basis, the NOI relative to the value of the property that you paid. So, I mean, if I'm one of those people that bought one of those Amazon deals for a 3.5 cap, and now I mean inflation's been 10, maybe even double digits the last couple of years, you got flipping killed. You took it in the shorts from a return perspective there.
Absolutely. And so this begs a question. I mean, it sounds to me like you view Bitcoin not necessarily as a replacement for real estate, but as a complement, right? Obviously, Bitcoin is an asset that's designed to absorb this monetary premium through time. People still need to live somewhere, they still need to work somewhere. Obviously, the utility value of these buildings is never going to go away, particularly housing, but we're talking about commercial real estate. But it's changing and it's shifting. And so, from your perspective, it sounds like your core thesis for the people at home is that Bitcoin serves as the perfect complement to real estate in this environment where we're going through radical changes in the way that these spaces get used.
So that's exactly right. So Bitcoin is a tool. It is a new tool. It's a new innovation that complements and enhances the real estate. That's the whole point of what I'm trying to get across here to the industry. I mentioned it earlier that moving forward, if you're going to be a relevant and profitable real estate investor, you're going to have a comprehensive strategy that you apply to an asset or across a portfolio. The days of buying a property, doing the absolute minimum, waiting for appreciation or inflation to do its thing and make it a profit, that game is largely over. Right. So that strategy, what does that look like? You have to optimize for you have to have a capital strategy, you have to have an energy strategy, you have to have a technology strategy, and you have to have an improvement strategy. So if I start with just the capital strategy, I like to call it my Bitcoin strategy, but capital strategy tends to resonate better with the real estate crowd. The capital strategy has a couple points. One is what percentage of your reserves are you holding in Bitcoin and what percentage are you holding in US dollar or US dollar equivalents? Point one. Point two is the financing mechanism. How are you using some of these new financing vehicles to get Bitcoin exposure? And then the third is how you're raising equity for your deals. I can see a scenario going back to that treasury point. I can see a scenario where an investor or a developer is holding a percentage of their US dollars in Bitcoin and the US dollars that they're not holding in Bitcoin, they're holding into a vehicle like Stretch, right? The world we're going into where capital scarcity is going to be front and center, you have to be innovative with how you're holding your capital. Bitcoin is just one of those, is one piece of that. The the second pillar is your energy consumption strategy, your energy efficiency. In commercial real estate, uh, energy is about 30% of your operating expenses, just roughly. And in every market, every property type, the last 5, 6, 7 years, that energy expense has been increasing double digits, which is far outpacing the fixed escalations in the lease, right? The rents are appreciating 3 to 4% a year. Your energy, if it's appreciating 15 or 20% a year, that's a problem, right? You have to, as an operator, you have to figure out how to get that as efficient as possible. And everybody knows about the solar and batteries and window tints and different sensors that you can utilize. But the forward thinking real estate investors are now able to consider Bitcoin mining and how they can integrate that into the building systems. I must say that it's a very new space. There's a lot of innovation taking place. So it's not necessarily ready, at scale today, but it's developing very, very quickly, and it will be commonplace before you know it. So as this gets rolled out at scale, you are able to essentially take your energy expense line and turn it into a profit bucket, a second income stream, because the Bitcoin mining helps subsidize the energy cost, and there's usually a little bit left over in the form of Satoshis. So that's really, really cool. And again, new area. I'm watching it really closely, but it's going to come very, very quickly. And are some applications and solutions available today? It's just, it's not always a foregone conclusion that it is feasible for the project you're looking at. The third category is your tech integration. Operators that are going to outperform, they're going to do two things really well. They're going to provide a superior customer experience, a superior tenant experience, and they're going to optimize the operational efficiencies. Technology helps you accomplish both of those things. So for on the tenant side or the consumer side, you can use various tech applications to customize the experience, right? Temperature, lighting, all of that. And it helps you amenitize the property. On the operational side, you can use these sensors and IoT devices to basically compile data in real time about the building and the systems, so you can make decisions faster and ultimately cut down on downtime and expenses. And it ultimately extends the useful life of a lot of these systems. So again, you're keeping your expenses lower, you're making decisions faster and in real time, that those decisions fall to your bottom line in a meaningful way. I mean, the fourth category is the renovation, the improvements, right? I mentioned it earlier about how capital intensive office space is in particular. If you're dropping 5, 6 figures every couple of years into a space to get it rent ready, that is capitally inefficient. So you have to figure out a way to reuse those improvements as much as you can. And in today's world, we have modular solutions, modular improvements that are a really good solution for this. And further on into the back half of this decade and into the 20s, 3D printing will become more and more applicable solutions here. So in today's world, the modular improvements, movable walls and partitions, it allows you to appeal to a broader audience, and you're able to reconfigure spaces in short periods of time without having to do a full gut and a redo. And again, if you're in this world where capital is scarce, expenses are through the roof, you have to find a way to control those costs. Otherwise, it's only a matter of time before you're out of the game.
Extremely well said. Any real estate operator who's listening to that, those are the four pillars, right? The four pillars of this new real estate strategy. How you as an operator can integrate Bitcoin into each aspect of your operations and make sure that you're insulating yourself from this continued monetary debasement that we're experiencing. Absolute masterclass, Chris. Thank you so much for for giving that to us. I want to talk about policy. I want to talk about where we are today as far as regulation goes, as far as risks go. You mentioned that obviously a lot of properties today are totally obsolete. I can't exactly recall the stat you mentioned, but a great deal of properties built during the 90s, very old. They need to be demolished or redeveloped, both of which are very capital intensive, but zoning kills progress. You've said 60% of US commercial property privately owned. What's the coming transition look like as far as regulation goes?
I mean, I'm here in Southern California. It is a absolute circus and just regulatory quagmire. I
You
mean,
could have
it
stopped
is.
the entire answer at I'm in Southern
I'm
California.
in Southern California. End of response. I mean, again, I can really only speak to, where I am in my local market. It is a challenge. Is plain and simple. I mean, I'm in Orange County, which is just south of Los Angeles County. Fortunately, it's not as bad here as it is in LA County or San Diego County. There's been some regulations passed over the last few election cycles that have been tremendously very punitive as far as the business and the real estate sectors are concerned. So much so that the municipalities are trying to figure out ways to amend or even repeal some of these pieces of regulation that went into effect. It's killed transaction volume. It's deterred investment in business. And I mean, this isn't really anything new for California. I mean, it's been happening as long as I've been paying attention to it. But the thing that concerns me is it's picking up speed. And we've gotten numb to the headlines of this business has relocated their headquarters from California to Texas, one from California to Florida, and so on and so forth. That trend has not slowed down just because you don't see it in the headlines. It's only picked up speed. And you also don't necessarily see the small and medium-sized businesses that are making that same decision. We need, and this is part of the call to action that I had put out online a couple months ago, was acknowledging that we can't do this. We can't make this transition alone as an industry, right? We have to be proactive about having these discussions with our elected officials and legislators, because the zoning piece is a huge bottleneck in the process.
Well,
So
I mean, yeah, go ahead.
no, that was it. Was the zoning regulations? It's a huge bottleneck in the process, and we have to do everything we can to engage those folks and educate them on, why this is so time sensitive, right? It can't take 2, 3, 4 election cycles. Like, we have to do this now.
Yeah, no, it is existential at this point. That's a word that's been thrown around in politics way too willy-nilly over the last decade. But I believe as far as true existential threats go, particularly for areas that have so much red tape set up, they are putting themselves up in a situation where over the next 5, 10, 20 years, as far as economic development goes, they're going to get killed, right? Because you have capital flight, and as it gets worse and as these deals get constrained, people are just going to continue moving elsewhere. Businesses are going to take their capital elsewhere. And so municipalities and regions that are more accommodative to redevelopment are going to be the ones that win.
Yeah, and I mean, just one quick comment, Joe, on the national level too. I mean, the Trump administration has put some stuff in place, some policies in place that are beneficial to real estate. The recent bill had to, it brought back 100% depreciation, made that permanent. 1031 exchange was maintained. There was a lot of real estate focused policy that was positive there. Qualified opportunity zones were renewed as well. But all of that is kind of downstream and missing the bigger point, right? So think of the qualified opportunity zones. These are areas around the country that are neglected, underserved. They need a lot of capital. They need a revitalization. And what they're trying to do is incentivize investment in these areas, right? Through different tax incentives and everything, with tax incentives essentially. But even if you can get some of these properties at attractive bases, you now have, this goes back to the improvements, right? The renovation costs is through the roof. The rents that you're going to be able to achieve in these markets, in these buildings, they don't necessarily justify the improvement costs. So I feel like we're still talking past the problem, right? And this comes back to the underlying system that we work in, and that we operate in, and that the fact that it's inflationary, and it is designed to increase prices over time. It doesn't mean that, the quality of things are getting better. So, that brings it back to Bitcoin again, and how this structural change, this secular transition we're experiencing, we're in the beginning innings of, it all comes back to the fundamental issue of Bitcoin being the solution.
Absolutely. And I tend to think that the more widely accepted Bitcoin is as collateral and the more that Bitcoin backlending proliferates, I hope that it can jumpstart these stalled projects. It can reinvigorate commercial real estate where it extends people's time preference rather than compressing it, and rather than extremely less capital intensive work, essentially, a souped up version of flipping houses for commercial real estate. It really reinvigorates the industry as a whole. Bitcoin has that transformative potential, just as it has that transformative potential in your personal life and my personal life as far as our own financial lives are concerned. So I want to kind of tie it all together in a bow and discuss the future landscape and really paint the vision here for commercial real estate 10 years from now, right? 10 years from now, 20, 30 years from now. if this all plays out. Bitcoin native financing spreads far and wide. You have buildings that are energy positive because they're mining Bitcoin. You have this financial system that's totally flipped on its head. What does commercial real estate look like in 2035 if all of this that we've discussed, these four pillars of the modern real estate operator, play out? What does that look like?
Love this question. And I think you framed it perfectly because it's a function of time horizon, right? I think overall, what it looks like in 20, 30 years is very different than, the immediate 10. I think the policy and the policy initiatives that have been put in place, Bitcoin specific, have been accommodative and very positive. In the commercial real estate world, I think over the next 10 years, you're going to see a handful of things. I think you're going to see values come down a little bit. I think they're going to be a lot more defensible and justifiable. I think right now they're just inflated beyond reason. I think you're going to see properties in which the tenants hold Bitcoin on their balance sheet. Those properties are going to trade faster, better, and at probably a premium relative to the properties that don't have Bitcoin native or Bitcoin friendly tenants. I think you're going to see higher quality locations, higher quality assets, higher quality destinations. The craftsmanship, the design is going to improve dramatically. One thing that drives me nuts about commercial real estate today is, they all look the same. Every shopping center, every office building, every industrial park, every apartment, right? Every apartment complex, they all look the same. There's
You
no,
really can't tell these days if you're entering into an apartment lobby or a hospital building. It all looks the same.
yeah,
I'm
yeah.
a bit of a hypocrite here because this is my office, but you'd think I'm in a hospital waiting room. But beauty in design is something that is sorely lacking now because, as you mentioned, people are just buying, flipping, selling. They're not there for the long haul.
Exactly. So I think the thing I'm most excited about is that piece of it, right? Flipping the incentives and incentivizing developers and investors to invest for the long term, have some skin in the game, make sure that the property is unique in one way, shape, or form, and it's a destination in and of itself. So I'm kind of I'm not I don't have an architectural background, but I love architecture. So I would love to see what some of these architects can do, what their creativity can do when they're just, let loose. I think it'll bring I think it'll be a much needed shot in the arm for our local community as far as just the pride of ownership and just the pride of being, part of that community when you see what, how some of these projects can be designed and, what they look like and the energy that they give off and the feelings that they exude.
Absolutely. Very well said.
Values, tenant mix, quality of work and architecture. I think those are probably the biggest changes you'll see between now and 2035. And I mean, I think if you're an active participant in this market and it's your core business, you have to be active for whatever reason. You should be really disciplined in what you're buying, and you should be looking at acquiring assets out of foreclosure or bankruptcy or at a replacement cost, 30 to 50% below replacement value. That's kind of your buy zone is the way I look at it. If you can get a property at that price point and then also say this is a great location and a great building, that's kind of the first filter, right? If you can check quality basis, quality location, quality property, then I would say let's look at this deal a little bit more. And from there, you can implement that strategy that I outlined earlier. If you can't buy it at that, that particular basis, it's okay. Pass on it. There are going to be a ton of opportunities to pick up amazing properties, amazing portfolios in the coming years.
Very well said. To talk about this, in one final way, I want to end this discussion on an air of optimism because that's ultimately what Bitcoin revolves around, right? Bitcoin has this transformative potential for real estate. I think in the past you've said that, and I believe you said this on Marty's show, you'd rather go down as the crazy Bitcoin guy who tried to warn everyone. So,
Yeah.
despite the challenges and despite the educational hurdle, what keeps you optimistic?
Despite the challenges in the education, what keeps me optimistic? I mean, what keeps me optimistic? I mean, seeing the evolution and the maturation in the space is one. Listening to guys like you and guys like Marty, one with some of these views. That keeps me optimistic and just understanding what Bitcoin will facilitate and permit as this process and as this cycle unfolds. I mean, that gets me up in the morning. It gets me excited. And, I want to be a part of it more than anything. So I would love to go down as, one of the crazy Bitcoiners that helped, you know, the real estate world transition into the Bitcoin era and, put my fingerprints on, what real estate looks like in a hyper Bitcoinized world. I would love that and I'm good with that. But I'm not going to sit by idly and do deals just for a quick commission and not with what I know, not with what, where I know this is going. That's just not in my
Very well said. So the final thing I'll say, I think this is the third time I've said that, but for those listening, to end off with, a CTA, whether anybody in real estate, right? Whether they're brokers, landlords, investors, what have you, what's the very first step that they should take tomorrow morning as far as understanding Bitcoin, beginning to integrate Bitcoin in their operations? What should they do tomorrow to get the ball rolling?
Step one is to start learning about Bitcoin. There are so many amazing resources out there today that meet you where you are, any, skill level, any education level. Start there, buy some Bitcoin, even if it's, 10, 15, $20. Start somewhere and start playing around with the technology, see what it's like. From there, I always, if you are a real estate owner or investor, evaluate your portfolio. The properties that are core and separate it from with the properties that are core and the ones that are not. The ones that are not, look for opportunities to dispose of them. Right? The ones that remain are the ones you focus on. And I would say figure out a way to implement a Bitcoin treasury strategy on those assets. Even if it's just 1 or 2% of the monthly cash flow, start allocating it to Bitcoin. The more you play around with this, the more you will get more comfortable, your understanding will grow, and your curiosity will grow. So that's where I'd say start. If you're a real estate person, wherever you are in the contractor, property manager, investor, I challenge you to be the first in your space to start talking about it and figure out how your business can benefit from Bitcoin.
Very well said. Wherever you are, Bitcoin can provide you balance sheet strength, particularly for an industry that is being as disrupted as heavily as commercial real estate. Chris, I couldn't have said it any better myself. Thank you so much for coming on the show, man. I think this was an episode that's been a long time coming. I love hearing about how Bitcoin is disrupting other industries, namely real estate. It's my favorite thing to talk about. So it was a great rip. Thanks so much for coming on. For people who want to hear more about you and what you have to say and follow more of your work, where can they find you?
You can find me on Twitter, Chris Driz with 3 Z's at the end. Once you find me on Twitter, you can pretty easily find all my other pages and platforms.
Fantastic. Chris, thank you so much for coming on the show. We'll talk to you soon.
Thanks, Joe.